creating a trading plan. So it's important for you to get a notebook out and basically sketch out the headings and the important things I'm highlighting under each heading I talk about. And this is the first trading plan I ever made. So I just quickly went through it, corrected a lot of it. A whole lot of it is nonsense. And obviously, the trading plan you create now isn't the same one you're going to use 5, 10 years from now. You're going to keep changing it, correcting it, making amendments. But it's important to notice where I'm correcting myself. Um, yeah. So let's jump into it. Number one, the first thing the first heading you should have is a risk profile. That's the first thing before you start talking about making profits in the markets. Before you talk about targets, number one is your risk profile. So I used to have 5% as my maximum risk. Problem with that is that it was way too high, and like I even told myself 1% is the best. But the problem was I did have a small account at the time. This was 2016, 2017. Anyways, so, and I wouldn't recommend this. I would just generally say don't increase to 5%, rather deposit more to stick to 1%. Yeah, so basically set out what percentage maximum you're willing to risk per trade, right? So say it's a $1,000 account. You vow to risk 1% per trade, which means every loss you make per trade should never exceed $10. If it's $100,000 account, your loss on that position you take should never exceed $10. Now, if you are going to gamble like most traders and open 10 positions, 5 positions, and don't care about risk profiling, that's up to you. What is your risk for different currency pairs and gold? So, for example, your risk could be 1%, but then for gold, you could half that to 0.5 by simply just halving your position size. So, if you normally open a 2 lot size for a currency pair, then you might want to halve it for gold and halve it for gold, say pound pairs, euro, US dollar, rand. No, sorry. You may want to have it for gold, um, euro rand, US dollar rand, and pound pairs, simply because they're they're more expensive and they carry more risk. That's why maybe you may want to halve your risk to 0.5. Risk for different patterns. For me, not all patterns are the same in the sense that I have different patterns I would allocate more money to than others. So, for example, for me, a normal, say my strategy, right? Let me get to it. Right. So say I was trading a divergence on the daily, right? Say I'd allocate um 1% to this trade, right? That risk isn't going to be the same for, let me get to it, for my two signature moves, right? For my two signature moves, I would allocate more than 1%. So say I'd allocate 3 to 5%. It's usually 5 to 7, to be honest. I allocate probably 3 to 5 times more than I usually would for a signature move. So this is the first one. Um, and basically, don't stress about signature moves. And this is the second signature moves. They're just two high probability patterns that I like, which have consistently done well for me. So it doesn't mean it's going to do well for you. You have to find your own special patterns that you like, that that make sense to you, right? So for me, those are my high probability. So you should have your own two or possibly even three setups that you like, that have consistently proven to do well for you. And then say maybe you'll allocate a little bit more risk to those pairs. So let's move on. Minimum drawdown. what is the maximum drawdown per month do you want? So say if you're having a losing month, what is the point where you're like, I'm going to stop trading for the rest of this month until I go clear my head, figure out what's going on, and basically your warning zone is, say it's, for example, 15 to 18%. That's your maximum drawdown. If you start losing more than that, you immediately close your trading account, do some reanalysis, some rejournaling, reviewing, and retesting, and basically close your account until the next month, because you don't want to exceed your drawdown. Because this drawdown could just possibly be for the next 3 months. That's why I'd say don't keep trading. If you've hit your drawdown for 15%, don't keep trading it down to like 38, right? Next part of it is the strategy profile. In fact, let me not say the strategy profile. I would say the style profile. And so this is just what you're giving a brief description of what kind of trading you do, right? What kind of a trader are you? There's no correct answer. It depends on you what kind of trading. Are you a swing trader? Apparently here, forex swing trading. So basically, what kind of a trader are you? This isn't your strategy. It's just giving a brief description. If someone was to open this book, they should immediately, in the next 5 lines, I gave way too much detail here, but in the next 5 lines, they should be able to see what kind of a style trader are you. Are you a swing trader? Are you a day trader? Are you a scalper? Are you a position trader? Are you a high frequency trader? Those who use algos and expert advisors and softwares, right? So you can't say I'm a swing trader, day trader, scalper, and position trader. Okay, you should have one style which you follow, and you should be able to give us in detail, not too much detail, but in some detail what it's about. So, for example, this is swing trading, right? Say you're like, I enter at these swings. I look for opportunities at these swings. This isn't a strategy. Swing trading is not a strategy. It's a style of trading. Please get that right. Swing trading is not a strategy. It's a type of trading. It's basically saying you look for opportunities in big swings of the markets, right? Um, Let me see. As traders, our job is to time the entries in a way that catches the majority of each swing body, right? So that's basically explaining that you want to be a swing trader and what you're looking for. Right. And then after that, let me see. After that, you want to have an analysis profile. An analysis profile basically tells you how you break down the market. What's your process of doing your analysis every day? So, for example, you may start from the daily time frame, right? Zooming out for a bigger picture of what's happening to basically look for the big swings, right? So, for example, for me, if I'm a trend trader, which is what I am, I will look for a trend movement, right? I'm looking for a huge trend so that I can time the reversal for a new trend to form. So that's what you'd basically be explaining here. So I'll be like, okay, um, I'm looking for a big trend in the market, and essentially that's what I'm targeting, right? So here it says move to the daily to see a bigger picture of what's happening with price action so that I can provide more reliable signals. Then you should let us know what's the best time frame for you. Some people perform better on the 1 hour, which is rare. Others perform better on the 4 hour, others on the daily. For me, when I was swing trading a lot of the times, it was mainly the daily that worked well. 4 hours, okay, it was okay, but the daily worked the best. Then the next process after scoping the swings was to draw the key support and resistance areas. This is just examples of my previous one. Then evaluate momentum, right? Because you can't just say I'm drawing the support and resistance and then once it hits that support and resistance, I'm buying or selling. That's not actually trading, because how do you know it's going to reverse? So I would evaluate momentum. And you mentioned which indicators you use or what you're using to show momentum, right? Are the higher highs and lows getting tighter? Is it a range in movement? There's volatility indexes that help you with assessing momentum, right? Anyways, So yeah, like I was saying, this is as it gets higher and higher or tighter and tighter on the lower time frames. That's how you're assessing momentum. This is just an example. Um, this is an example of me putting the resistance and the support areas I was talking about. Um, pin bars, put that. If you trade candlesticks, you should also put that in there. Step 4, watching out for trade signals, buy signals at key supports. This is actually quite detailed. Now, your plan doesn't have to be, your style section doesn't have to be this detailed. Your strategy needs to be detailed, not the style, right? Identify exit points. So say I've just finished watching out for price signals to buy or enter. After I've done that, you should also know when you're going to exit. It doesn't help you to just know when you're entering and then, just set a stop loss and then that's the end of the story. You should know when you're exiting, right? Um, identify both these levels before risking capital. That's important. So say you're going to enter here, you're going to take profit at this next high here. Next, right? So we've just finished. This is the last step. So calculate and manage risk. Remember, I'm still talking about style. I think I was on style. Is that the heading I was on? Yeah, the analysis profile. So the analysis profile doesn't have to be in this much detail, but if you want to have it in that much detail, you can. But these are just basically steps that you should be taking. Or say, for example, you want to be taking before you enter a trade. These are the steps. We finished exit points, and then importantly, calculate and manage risk. We've talked about risk, but importantly, you have to tell us what risk to reward profile are you looking for. So you'll set a minimum for yourself and you'll say, listen, I will never enter a trade that's less than 1 to 3 risk to reward. Meaning, if you have $100 account, you're not entering a trade unless you stand to take profit at no. Say you have a $1,000 account. You say to yourself, I'm risking $10, which is 1%. I am not entering that trade unless there's a chance that I'm going to make $30 in profit, right? So it's $1,000 account. You're risking $10, which is 1%, for the opportunity to make $30, which is 3R. So you say to yourself, I don't enter trades which are less than 3R. So if you're going to just double your money, say it's an entry that you're risking $10 and you stand to make $20, then you don't enter it. How do you calculate how much you stand to make and lose? A lot of brokers have calculators, their risk calculators. They show you basically how much you stand to lose, how much you stand to win. I use XMs. In fact, you don't even, on my charts, you can actually see on your MetaTrader, if you just move your arrow, you should be able to see roughly how much you stand to make, how much you stand to lose. If you want me to show you, I'll just show you after I've finished all of this. So you've calculated and you've managed your risk. If it's within your risk profile, so say it's a 1:5R multiple, then you take the trade. And then obviously you should know when you want to get out. This is a whole lot of nonsense that I was writing about my trading plan, which I don't think is important, to be honest. Right, then the juicy stuff, the strategy profile. You must give a detailed section of your strategy. What kind of a trader are you? Are you a trend trader? Are you a divergence trader? Are you a head and shoulders trader? When do you enter and when do you exit, right, as part of your strategy? And then what confluences are in your strategy? So for example, if let me show you, say, my strategy here. So you see what the strategy section is about. So say I say My aim is to catch the double tops and the W's. It's a divergence for the second leg divergence. Um, I'll explain what divergence is later on. I look for trade opportunities on the 1 hour time frame, and we try to find entry opportunities on the 15 time frame. The aim is to get 30 to 50 pips per trade. As you get better, you can aim for higher. For determining divergences, we require an indicator called TDI. It doesn't come with the MetaTrader 4 platform, but that's fine. So already I've sort of explained to you that I'm targeting 50 pips and then I'm out. I trade on the 1 hour. I'm looking for divergences. I use the TDI indicator. Usually, I would take profit at the 200 moving average. I think I forgot that. Yeah, but that's another story. So then I explain what is this divergence trading, which is part of my strategy, say. And then you want some pictures of some back testing you've been doing. So what's a, a good entry for you? And then which are your signature moves? Are there certain patterns that you've seen that you do really, really well with? So for example, this is my signature move number 1. It has a high win rate. So it's usually like something that looks a bit like a, a bullish pennant, right? And then right in this area somehow, some divergence forms, and then it transforms and it falls. Basically, hard to explain, but essentially that's my signature move. It has a high win rate, right? And then here you go. So you can see what it looks like on a proper chart. We have tested it out. As you can see, signature move number 2. This is another one I like, which is like a bullish flag. And then right here, divergence forms. And then you sell to this target area here. And then, like I showed here, this is what it would look like on the charts. So is there anything else I want to show you? Yeah, so what confluences are in your strategy? So let's say I was taking a signature move, right? If I saw a signature move on the pound US dollar, for example, I would first, number 1, for me, confluence is basically a confluence is what are the factors you look at before you enter a trade. So, for example, before a doctor diagnoses you with COVID-19, you're not going to just walk in and say, I'm coughing, and then he says you have TB or COVID. There's certain symptoms he looks for, multiple symptoms, and then he can make a diagnosis. So similar to you, you have to look at certain factors before you enter a trade. So for me, say it was a signature move and it's on the US dollar rand. Here, I do not enter until we've broken, first of all, identify the pattern. You identify that it's a signature move and it's the first signature move. And then first, what I like to wait for is a break of this, this resistance area. Once we've broken, that doesn't mean sell. For me, I wait for a divergence. And then after the divergence, that's when I sell. Obviously, I sell with risk borne in mind. Here was a little bit different. We didn't break through this resistance, right? But we did see the divergence forming. So that just tells you you can't also be too strict on your trading plan. You made the trading plan, it wasn't made for you, right? So stop. You can't be a prisoner to your trading plan and say it's not perfect, it doesn't look perfect on the chart, because it's never going to look perfect on the charts. So like I said, basically my confluences are, first I look for the pattern. Number 2, I like to wait for a breach. Number 3, the divergence for entry. My risk profile has to be correct. How much am I risking per trade? And then have a stop loss. That's it. So we download confluences. Close the trading plan with your target profile. So the next section of your trading plan should have a targets profile. Roughly, what is your target? What's your yearly target? What's your monthly target? I would suggest that for beginners, aim for 35% a year. That is like, if you can do that, have a strategy you've tested and make 35% a year, risking 1% or 0.5%. If you can do that, Realistically, your monthly target isn't important, because I remember when I started out, I'd be so focused on the monthly target. I'd be like, I didn't make 10% or 15% this year. Oh my gosh, and I'd be so stressed about it. And then you try to force trades which aren't there and which don't exist. So don't be a slave to your monthly targets either. So that's important. Sorry, I was just checking your trade. Yeah, so don't be a slave to your monthly target. What's important is your yearly target and your target drawdown. Re restate it again, and then you end your trading plan with what I think is really important: your trading commandments or your principles. There's a great book by Ray Dalio called Principles, and it's important because, like most traders, Ray Dalio lost his entire hedge fund. He blew his entire hedge fund. He thought he was going to be correct, and he risked his entire portfolio. He lost everything, and he created principles for himself. For me, I didn't know about his principles, but when I started out, I drew myself commandments, and these were commandments that I swore to myself I would never break. When you trade, you have to have discipline, and you have to have someone that holds you accountable. And unfortunately, you have to be the one who holds you accountable. No one's going to hold you accountable. The broker's not going to stop you from putting in all your entire account in one trade. They're not going to stop you, believe me. So, for example, risk management, this is the most important rule. Like, that's my most important commandment. I actually haven't updated this, even though I wanted to. Like I said, I used to be so hung up on trying to make 10%, 15% per month, and I've changed from that. Moving my stop losses, um, letting your trades play out to continue the entire pattern. You don't have to trade everything. Just because you have an idea doesn't mean you have to trade it. You don't have to trade everything on the broker's list. Learn from your mistakes. Keep your analysis for the week and learn from them. Always stay learning and correcting yourself. Certain patterns work better on certain pairs and not others. Don't ever risk more than 5%, even if I'm confident that it's a home run. Learn to accept losses. Focus on your percentage growth and not the money. Too much will kill you in trading. And still, I vow by this, because actually this was like my first commandment on 14, which is too much in trading will kill you. And that means you can't be learning from everyone. You know, subscribe to every channel, subscribe to every newsletter, subscribe to read every book. It will actually negatively affect your trading. You should have one method of trading, and then the rest is nonsense. Stick to something that makes sense and trade that. Most strategies work if you stick to them. Yeah, a lot of people just back out of strategies that work, and they have a losing month, and then they're like, yeah, the strategy doesn't work. And then apparently they're looking for the holy grail. Yeah, they're looking for the perfect strategy which has a win rate. And I'm here to tell you that your win rate actually means nothing. Look at this news. I've seen students with a 76% win rate, 76% win rate, and still nearly blowing their accounts, right? And that's because they haven't focused on risk to reward profile. So they're more focused on winning a position, right? Then as it's in profit, they close, right? And then they hold their losing trades until they can't stomach the losses, and then they start closing. I've seen it. So honestly, a strike rate and a win rate isn't even important. Always have a stop loss, understanding correlations, understanding the relationship between gold, US dollar, and the yen. Yeah, and so forth. And that's pretty much it in your trading plan. And then if you want, you can add some affirmations there. And that's as detailed as it can be. So possibly maybe it might be a bit long when you add your strategy section into it, but it's always important to keep reviewing your trading plan over and over again.